There are books that inform, and then there are books that transform. The Education of a Value Investor by Guy Spier is firmly in the second category. This is not just a book about how to pick stocks or analyze balance sheets. It is a deeply personal story about how one man completely changed the way he lived, the way he thought, and the way he invested. It is a story about learning from mistakes, about finding the right mentors, about building the right environment, and about discovering that the most important investment you can ever make is the investment in your own character. If you have ever felt lost in the world of investing, if you have ever wondered why smart people keep making the same financial mistakes, or if you have ever felt that something important was missing from your professional life, then this book speaks directly to you. Guy Spier did not start his life as a wise and thoughtful investor. He started it as an ambitious, status-hungry young man who wanted to win at all costs. He went to the right schools, he got the right degrees, he wore the right suits, and he worked at the right firms. And yet, despite all of that external success, he felt empty inside. He was making decisions that he later realized were deeply wrong, not just financially, but morally. He was surrounding himself with people who rewarded dishonesty and punished integrity. He was playing a game that was designed to bring out the worst in human nature, and he was losing himself in the process. But then, something remarkable happened. Guy Spier discovered Warren Buffett. He discovered Charlie Munger. He found Monish Pabrai. And slowly, gradually, one lesson at a time, he began to rebuild himself from the ground up. He left Wall Street. He moved to Zurich. He created his own fund, the Aquamarine Fund, and he built it according to his own principles. He learned to be honest about his mistakes. He learned to think long-term. He learned to value integrity over profit. And in doing so, he not only became a better investor, but a better human being. This is the story of that transformation. And it holds lessons, not just for investors, but for anyone who wants to live a more meaningful, more honest, and more successful life. Guy Spier was born and raised in a comfortable environment. He grew up with access to good education and opportunities that most people in the world can only dream of. From an early age, he was driven by a desire to succeed, to prove himself, to be recognized as smart and capable. This desire led him to Oxford University in England, one of the most prestigious academic institutions in the world. At Oxford, he studied philosophy, politics, and economics, a course that was famous for producing the kind of well-rounded thinkers who could go on to lead companies, governments, and institutions. But Oxford, for all its brilliance, also had a darker side. It was a place where status mattered enormously. Who you knew, which social clubs you belonged to, how you presented yourself, all of these things counted for a great deal. And Guy Spier, like many young people in such an environment, began to absorb these values without really questioning them. He began to measure his worth by external standards, by the prestige of the institutions he was associated with, by the opinions of the people around him. After Oxford, he went on to Harvard Business School, another legendary institution that sat at the very top of the global hierarchy of academic prestige. Harvard Business School was an extraordinary place, filled with incredibly driven, talented, and ambitious people. The case study method it used was famous for sharpening analytical thinking and decision-making skills. The network you built there could open doors that remained closed to almost everyone else in the world. For a young man who wanted to succeed in business and finance, there was arguably no better place on earth to spend 2 years. But Harvard Business School also had its own culture, a culture that was very much focused on winning, on getting to the top, on maximizing personal financial gain. The students there were extraordinarily competitive, and while many of them were genuinely good people, the overall atmosphere pushed everyone toward a particular definition of success. That definition was mostly about money, prestige, and power. And once again, Guy Spier absorbed these values, perhaps without fully realizing it. He graduated from Harvard Business School with high hopes and a powerful network. He was ready to conquer the world of finance, and the world of finance was ready to receive him, or so it seemed. His first real job after Harvard was at a firm called D.H. Blair, and this is where the story takes its darkest turn. D.H. Blair was, to put it plainly, not a reputable firm. It was a place where the culture was built around deceiving clients and making money at their expense. The brokers there were trained to use high-pressure sales tactics to recommend stocks that would generate the highest commissions for the firm rather than the best returns for the clients, and to prioritize short-term profit above all else. It was, in many ways, the opposite of everything that value investing stands for. Guy Spier worked there for a period that he later described as deeply damaging to his character. He was surrounded by people who lied, who manipulated, who cheated, and who celebrated all of it. And the scary thing, the thing that he reflects on with great honesty in his book, is that he began to participate in this culture himself. Not because he was a bad person at his core, but because the environment he was in was so powerful, so all-encompassing, that it began to shape him in ways he did not fully recognize at the time. This is one of the most important lessons in the entire book. The environment you are in has an enormous influence on who you become. If you spend your days surrounded by people who cut corners, who value short-term gains over long-term integrity, who treat other people as tools to be used rather than human beings to be respected, then you will inevitably start to drift in that direction yourself, even if it goes against your deepest values. The environment is not neutral. It is always pushing you in one direction or another, and if you are not very careful, very intentional about the environment you choose to be in, you may find that you have become someone very different from the person you wanted to be. This realization came slowly to Guy Spier. It did not arrive in a single dramatic moment. Instead, it crept up on him through a growing sense of discomfort, a feeling that something was deeply wrong with the way he was living and the choices he was making. He began to feel a kind of moral unease that he could not easily ignore, and it was in this state of searching, of questioning, that he first seriously encountered the ideas of Warren Buffett. Warren Buffett, of course, is the most famous investor in the history of the world. Born in Omaha, Nebraska, in 1930, he began investing as a child and built one of the greatest fortunes in human history through decades of patient, disciplined, principled investing. But what Guy Spier discovered, as he began to read about Buffett and study his methods, was that Buffett was not just a great investor, he was a great human being. And the two things were not separate. They were deeply, fundamentally connected. Buffett's approach to investing was built on a foundation of integrity, patience, and clear thinking. He did not try to outsmart the market through complex financial instruments or rapid trading. He looked for businesses that he could understand, businesses that had durable competitive advantages, businesses that were run by honest and capable managers, and he bought them at prices that offered a margin of safety. Then, he held them, often for many years, allowing the power of compounding to work in his favor. But more than the investment methodology, what struck Guy Spier most deeply was the way Buffett lived. Buffett famously still lived in the same modest house in Omaha that he had bought decades ago. He was not driven by status or by the need to impress others. He did what he loved, day after day, year after year, and he surrounded himself with people who shared his values. He was honest to a degree that was unusual in the world of finance. He was generous with his time and his knowledge, and he seemed to be genuinely happy, not in a superficial way, but in a deep, settled, contented way that came from living in alignment with one's own values. For Guy Spier, discovering Buffett was like finding a lighthouse in a storm. Here was proof that you could be enormously successful in the world of finance without losing your integrity. Here was a model of what a great investor and a great human being looked like. And Spier began the long, difficult, deeply rewarding process of trying to learn from that model. He started reading everything he could find about Buffett. He read the annual letters that Buffett wrote to the shareholders of Berkshire Hathaway, the company that Buffett had built into one of the most valuable in the world. These letters, written in plain English, full of wisdom and humor and honesty, became a kind of guide for Guy Spier. He read them over and over, trying to absorb not just the investment insights, but the underlying philosophy of life that Buffett was sharing. He also discovered Charlie Munger, Buffett's longtime partner and one of the greatest thinkers in the world of investing and beyond. Munger's approach was built on what he called mental models, a collection of frameworks drawn from many different fields of knowledge, including psychology, physics, biology, economics, and history, that could be used to think more clearly and make better decisions. Munger was famously direct, even blunt, in his assessments. He had no patience for sloppy thinking or for the kind of self-deception that he saw all around him in the financial world. And his ruthless intellectual honesty was something that deeply impressed Guy Spier. Through reading Buffett and Munger, Spier began to build a new framework for thinking about investing and about life. He began to understand the importance of what Munger called the psychology of misjudgment, the many ways in which human beings systematically mislead themselves and make terrible decisions because of cognitive biases, emotional reactions, and social pressures. He learned about confirmation bias, the tendency to seek out information that confirms what you already believe, and to dismiss information that challenges it. He learned about social proof, the tendency to go along with what other people are doing because it feels safer than standing alone. He learned about incentive bias, the powerful tendency of people to behave in ways that serve their own financial interests, even when they genuinely believe they are being objective. These insights were deeply uncomfortable because they forced Guy Spier to look honestly at his own thinking and his own behavior. He had to admit that he had been subject to all of these biases. He had gone along with the culture at D.H. Blair, not just because he needed the money, but because the social proof of everyone around him behaving that way had made it seem almost normal. He had made investment decisions based on what he wanted to be true, rather than what the evidence actually showed. He had been driven by incentives, by the desire for profit and prestige, in ways that had corrupted his judgment. Admitting all of this was painful, but it was also liberating. Because once you can see the forces that have been distorting your thinking, you can begin to put safeguards in place to protect yourself from them. You can build a process, a set of habits and rules and checks that makes it harder for bias to creep in and easier to think clearly and honestly. This was the beginning of Guy Spier's real education as an investor. One of the most significant events in that education was the famous lunch with Warren Buffett. Every year, Warren Buffett auctions off the chance to have lunch with him, with all the proceeds going to charity. It is one of the most coveted experiences in the world of investing. People have paid extraordinary amounts for this opportunity, and many of them have described it as one of the most valuable experiences of their lives. Guy Spier, together with his friend and fellow investor Monish Pabrai, bid on and won this lunch. The price they paid was enormous, a remarkable sum for a few hours of conversation. But as Spier reflects in his book, it was worth every penny, and not necessarily for the reasons you might expect. What made the lunch so valuable was not primarily the investment advice that Buffett shared, although there was plenty of wisdom in the conversation. What made it truly transformative was the experience of being in the presence of someone who had achieved an extraordinary level of inner peace and integrity. Buffett was not performing for them. He was not trying to impress them. He was just himself, warm, curious, funny, genuinely interested in the people across the table from him, and absolutely at ease with who he was. There was no gap between the public Buffett and the private Buffett. What you saw was what you got. This was a revelation for Guy Spier. He had spent so much of his life performing, presenting a version of himself that he thought others would approve of, concealing his doubts and his weaknesses, trying to project an image of confidence and success even when he did not feel it. And here was one of the most successful and admired people in the world, sitting in a steakhouse in New York, completely relaxed and completely genuine. It showed Speer that the kind of life he wanted to live was actually possible. It gave him permission to stop performing and start being. The influence of Mohnish Pabrai on Guy Spier's development deserves its own extended discussion because Pabrai is a truly remarkable figure whose story and methods had a profound effect on Spier's thinking. Pabrai grew up in India and moved to the United States, where he built a successful technology business before turning his attention full-time to investing. He is famous for his approach of studying what the best investors in the world are buying and then making similar investments based on his own careful analysis. But what struck Guy Spier most about Pabrai was not his investment methods. It was his character. Pabrai was deeply honest, deeply generous, and deeply committed to living according to his values. He was someone who had thought very carefully about what a good life looked like and was genuinely trying to live that life. He was also someone who had been shaped by the teachings of great thinkers and spiritual figures, and who brought that depth of reflection to everything he did. The friendship between Spier and Pabrai became one of the most important relationships in Spier's life. They talked about investing, of course, but they also talked about philosophy, about psychology, about how to be a better human being, about the relationship between character and success. And through these conversations, Spier continued to deepen and refine his own thinking. One of the key lessons Spier learned from his study of Buffett and from his friendship with Pabrai was the enormous importance of environment. This lesson goes far beyond just choosing the right workplace. It encompasses everything about the physical and social world you inhabit, the city you live in, the people you spend time with, the information you consume, the rituals you practice, the habits you cultivate. Buffett famously chose to live in Omaha rather than in New York, the financial capital of the world. Many people assumed this was a disadvantage, that being far from the center of action would cut him off from crucial information and networking opportunities. But Buffett saw it differently. By living in Omaha, he was insulating himself from the noise and the herd mentality of Wall Street. He was able to think more clearly, more independently, more long-term, precisely because he was not surrounded by people who were all caught up in the same short-term obsessions. This insight struck Guy Spier with enormous force. He began to think seriously about his own environment and whether it was conducive to the kind of investor and the kind of person he wanted to be. And he came to a remarkable conclusion. New York, for all its energy and opportunity and excitement, was not the right place for him. The culture of Wall Street, the social norms of the financial world in New York, the constant pressure to be busy, to be trading, to be making deals, all of this was working against the kind of patient, long-term, quality-focused investing that he wanted to practice. And so, he made a decision that many of his colleagues thought was bizarre, perhaps even a little crazy. He moved to Zurich, Switzerland. This decision was not made lightly. It involved uprooting his life and his business, adapting to a new culture and a new language, and leaving behind a network that had taken years to build. But Spier became convinced that it was the right thing to do, and the results proved him correct. In Zurich, away from the noise and pressure of Wall Street, he found that he could think more clearly. He could take his time with investment decisions. He could maintain a more balanced perspective. He was not constantly being pulled into the frenetic short-term thinking that dominated the New York financial world. The move to Zurich also had a personal dimension. It allowed Spier to build a family life, to be present for his children, to pursue interests and friendships that were not exclusively focused on finance. He became involved in the local community, formed deep friendships with people from all walks of life, and began to cultivate the kind of well-rounded existence that he believed was essential for long-term happiness and good judgment. The Aquamarine Fund, which Spier had established as his investment vehicle, began to find its rhythm in Zurich. Spier managed the fund according to principles that he had derived from his study of the great value investors. He focused on businesses that he could genuinely understand, businesses with strong and durable competitive advantages, businesses run by managers of proven integrity and competence. He was patient, willing to wait for the right price before committing capital. He was honest with his investors, sharing his thinking and his mistakes openly in his annual letters. Those annual letters became one of the most distinctive and admired features of the Aquamarine Fund. Spier modeled them partly on Buffett's shareholder letters, but he gave them his own character. He was willing to discuss not just what had gone well, but what had gone wrong, and why. He was willing to explore the psychological and emotional dimensions of investing in a way that most fund managers would never dare to do. He wrote about his own biases, his own mistakes, his own continuing education as an investor. And investors responded to this honesty with loyalty and with trust. Writing these letters was itself a kind of discipline for Spier. The process of putting his thinking on paper, of explaining his reasoning in plain language that anyone could understand, forced him to be clear and honest with himself. It was impossible to hide behind jargon or complexity when you were trying to write for an audience that included people with no financial background. You had to actually understand what you were talking about. And when you did not understand something, the writing process made that very clear. This practice of writing as a form of thinking, of using the act of putting words on a page to sharpen and clarify your reasoning, is something that Spier recommends strongly to anyone who wants to become a better investor. It is a form of the journaling and reflection that many of history's greatest thinkers have practiced. And in the age of social media and constant distraction, it is more valuable and more rare than ever. One of the most practically significant parts of Guy Spier's investment education was his development of an investment checklist. The checklist idea came partly from reading about the surgeon and public health researcher Atul Gawande, who had written a famous book about how simple checklists could dramatically reduce errors in complex, high-stakes environments like operating theaters and airplane cockpits. Gawande argued that even the most expert and experienced practitioners made avoidable mistakes because they were operating under pressure, with limited time and incomplete information, and that a systematic checklist could help them catch the things that their stressed and distracted minds might otherwise miss. Spier realized that exactly the same logic applied to investing. Every investor, no matter how smart and experienced, is subject to a range of cognitive biases and emotional pressures that can lead to terrible decisions. The heat of the moment, the excitement of a new idea, the social pressure of a strong recommendation from a respected colleague, all of these things can cause you to skip past important warning signs that, in a calmer moment, you would never have missed. The investment checklist is a way of ensuring that you do not skip past those warning signs. It is a list of questions that you ask yourself about every investment you are considering, questions that are specifically designed to catch the most common and most dangerous errors. Some of these questions are financial and analytical in nature. Is the business generating strong and consistent cash flows? Does it have a durable competitive advantage? Is the management team honest and competent? Is the valuation reasonable in light of the business fundamentals? But other questions on the checklist are psychological and behavioral in nature. Am I being influenced by social proof, by the fact that other smart investors own this stock? Am I falling for authority bias, deferring to the opinion of an expert without doing my own analysis? Am I subject to commitment and consistency bias, holding on to an investment past its best point simply because I have already publicly committed to it? Am I facing any conflicts of interest that might be distorting my judgment? The checklist does not make the final decision for you. It is not a mechanical system that removes the need for judgment and wisdom, but it does ensure that you approach every investment decision with a minimum level of rigor and honesty, and that you do not fall prey to the same errors that have destroyed so many investors. Spier's checklist evolved over many years. It grew out of his own mistakes and out of the mistakes he observed in others. Each new error, each painful lesson added a new item to the list. And over time, it became an increasingly powerful tool for catching problems early, before they turned into catastrophic losses. The psychological dimension of investing is one of the themes that runs most deeply through the entire book. Spier is fascinated by the ways in which human psychology works against good investment decision-making, and he draws heavily on the work of Charlie Munger and on the academic research in behavioral economics and psychology to illuminate these patterns. One of the most powerful of these patterns is what is known as the Lollapalooza effect, a term coined by Charlie Munger to describe situations where multiple cognitive biases all work together in the same direction at the same time, creating a kind of compounding of irrationality that can lead to extraordinarily poor decisions. Munger noted that a single bias might push you slightly off course, but when several powerful biases are all pushing you in the same direction simultaneously, the result can be catastrophic. Think about what happens when a stock market bubble is forming. Social proof tells you that buying is the right thing to do because everyone else is buying. Authority bias tells you that the experts who are talking up the market must know something you do not know. Commitment and consistency bias makes you reluctant to change your view once you have bought in. Loss aversion makes the prospect of missing out on further gains feel more painful than the prospect of losing the money you already have invested. And the optimism that comes from a rising market can make you systematically underestimate risks and overestimate the likelihood of continued gains. All of these forces are pushing in the same direction, and the result is that otherwise sensible, intelligent people can convince themselves to pay 10 times or 20 times what an asset is rationally worth. Understanding these patterns and building systems that protect against them is at the heart of what Spier calls creating the right environment for good decision-making. The physical environment matters because being calm and comfortable helps you think more clearly than being stressed and rushed. The social environment matters because the people around you will inevitably influence your thinking. The informational environment matters because the quality of the information you consume will shape the quality of your analysis. And the temporal environment matters because the timing of when you make decisions can have a significant effect on the quality of those decisions. On this last point, Spier developed a rule that he calls the 24-hour rule. Whenever he receives a pitch from a broker, a recommendation from a colleague, or comes across a new investment idea in his reading, he makes it a strict policy not to act on it for at least 24 hours. This simple rule creates a cooling-off period that allows the initial excitement to subside and the more rational, analytical part of his brain to catch up. Many investment mistakes are made in moments of excitement or enthusiasm when the emotional brain is in control. Giving yourself time to sleep on it allows the rational brain to do its work. He also developed a rule about not taking phone calls from brokers during market hours. This might sound strange, because brokers are supposed to be useful sources of information and ideas. But Spier found that conversations with brokers, who are inevitably trying to generate transactions that will produce commissions for them, had a subtle but consistent negative effect on his decision-making. They would introduce ideas that sounded compelling in the moment, but that he would later see as poor investments. They would create a sense of urgency that was artificial, pushing him toward decisions he was not ready to make. By simply not taking these calls, he removed a significant source of bias and noise from his investment process. These rules and habits might seem overly rigid to some people, but Spier argues that they are essential precisely because of the psychological forces he is trying to guard against. The biases that lead to poor investment decisions are not ones you can simply decide to overcome through willpower. They are deep-seated features of human psychology that have been shaped by millions of years of evolution. You cannot fight them directly. You can only manage them by designing your environment and your process in ways that make them less likely to take hold. This insight, that the design of the environment is more powerful than individual willpower in shaping behavior, is one of the most important lessons in the entire book. and it has applications far beyond investing. In every area of life where we want to behave well and make good decisions, from our diet and exercise habits, to our relationships, to our financial choices, the environment we create around ourselves will have a more powerful effect on our behavior than the strength of our intentions alone. Another important theme in the book is the value of mentors and of learning from people who are better than you. Spier is deeply grateful to the many people who have taught him, whether directly, as in the case of his lunch with Buffett and his friendship with Pabrai, or indirectly, through their writings and their public example. He writes movingly about the experience of reading the works of great thinkers and investors, and of feeling that he is engaged in a kind of ongoing conversation with them across time. The letters of Buffett, the talks of Munger, the writings of Benjamin Graham, who was the father of value investing, and Buffett's own most important teacher, all of these became part of the fabric of his thinking. He returned to them again and again, finding new layers of insight each time as his own experience and understanding deepened. He also emphasizes the importance of not just consuming the ideas of great thinkers, but of genuinely internalizing them, of making them part of how you actually think and behave, rather than just a set of intellectual concepts you can discuss at a dinner party. This is much harder than it sounds. Reading about the importance of patience is easy. Actually, being patient when the market is moving against you and your investors are asking questions, and the temptation to do something, anything, is overwhelming, that is an entirely different challenge. Spier learned through painful experience that the gap between knowing the right thing to do and actually doing it can be enormous. And he came to believe that the only way to close that gap is through practice, through repeated, deliberate attempts to apply the principles you believe in, through honest reflection on your failures, and through the cultivation of the habits and structures that make good behavior more likely. One of the most interesting and somewhat unconventional chapters in the book deals with Spier's views on prayer and spirituality. He is not evangelical about his beliefs, and he is careful to distinguish between the religious and the secular dimensions of his practices. But he describes a practice of daily reflection and what he calls non-transactional gratitude that has been important to his sense of well-being and, he believes, to the quality of his thinking. This is the practice of taking time each day to think about the things in your life that you are grateful for, not in a performative way, not as a transaction where you express gratitude in hopes of receiving more, but as a genuine acknowledgement of the good things that you have been given and that you so easily take for granted. Spier found that this practice had a grounding effect, helping him to maintain perspective during difficult times and to resist the anxiety and fear that can so easily distort an investor's thinking when markets are going badly. There is something deeply practical about this apparently spiritual practice. When you are genuinely grateful for what you have, you are less driven by the desperate need to accumulate more. And when you are less desperate, you make better decisions. You are more patient. You are more rational. You are more willing to hold through periods of temporary loss, knowing that your fundamental security does not depend on the daily fluctuations of a stock price. This connects to a broader theme about the relationship between inner life and outer performance. Spier came to believe that the quality of your investment decisions is ultimately inseparable from the quality of your character. Not in a moralistic sense, not as a judgment that bad people make bad investors, but in a more fundamental sense. The biases and distortions that lead to poor investment decisions, the fear, the greed, the ego, the status seeking, the short-term thinking, are all expressions of a particular relationship with oneself and with the world. And the antidote to these biases, the patience, the honesty, the integrity, the long-term perspective, are all expressions of a different and healthier relationship with oneself and with the world. This is why Buffett's character matters so much in the book. It is not just that Buffett has good investment methods. It is that his good investment methods are an expression of his character. The patience comes from genuine equanimity. The honesty comes from a deep commitment to truth. The long-term thinking comes from a genuine sense of who he is and what he values that does not depend on the short-term validation of other people's approval. You cannot separate the investor from the person. They are the same thing. For Guy Spier, working toward this kind of integration, this kind of alignment between who you are and how you invest, has been the central project of his adult life. And it is a project that he acknowledges is never finished. He is still learning. He still makes mistakes. He still catches himself subject to biases he thought he had overcome. But the direction of travel is clear, and the progress, while slow and uneven, is real. One of the most valuable passages in the book deals with Spier's approach to maintaining investment discipline during periods of market turmoil. The financial crisis of 2008 and 2009, when markets around the world fell dramatically, was a genuine test of every investor's convictions and every investment framework. Many funds were forced to liquidate as investors, terrified by the magnitude of the losses, pulled their money out. Many individual investors sold at the bottom, locking in catastrophic losses, only to miss the subsequent recovery. Spier writes honestly about his own experience during this period. He was not immune to fear. He was not some robotic machine that processed market data without emotional response. He felt the same terror that gripped the entire financial world as asset prices collapsed and the global economy teetered on the edge of catastrophe. But he had prepared himself, through his study of market history and through his understanding of his own psychology, to resist the impulse to sell at the worst possible moment. He understood, because Buffett and Munger had taught him to understand, that market crashes are a normal and inevitable feature of the investing landscape. They are not signs that the system is broken or that investing no longer works. They are temporary repricing events, driven by fear and uncertainty, during which the prices of good businesses fall to levels that offer extraordinary value to patient and courageous investors. The investors who can maintain their composure during these periods, who can continue to see the underlying value of the businesses they own, even as the stock prices fall dramatically, are the ones who achieve the best long-term results. He also understood that the discipline required to maintain that composure is not something you can manufacture in the moment of crisis. It has to be built up over years of study and reflection. You have to have done the work in advance, reading the history of past market cycles, understanding how and why markets overshoot in both directions, internalizing the lesson that the fear of permanent loss and the reality of temporary loss are very different things. Only then, when the crisis actually arrives, do you have the mental and emotional resources to act rationally rather than reactively. The book also contains important lessons about the structure of the relationship between an investment manager and his investors. Spier writes about the deliberate choices he made in designing the Aquamarine Fund to minimize the pressures that would work against long-term investing. He was very selective about the investors he accepted into the fund, preferring those who shared his long-term perspective and who could be expected to stay the course during periods of underperformance, rather than chasing the maximum amount of money from investors who might panic and redeem at the worst possible time. He also structured his fee arrangement in a way that he believed aligned his interests with those of his investors. He was not interested in maximizing assets under management for the purpose of collecting larger management fees regardless of performance. He wanted to prosper if and only if his investors prospered. And he wanted to build relationships with investors based on trust, transparency, and shared values rather than on the promise of short-term returns that might not be sustainable. These structural choices had significant financial implications for Spier. He could have grown the fund much larger and earned much more in management fees if he had marketed it more aggressively. But he chose not to do so because he knew that a larger and less carefully selected investor base would create pressures that would ultimately undermine the quality of his investment process. He was choosing the long term over the short term, integrity over expediency, exactly the principles he was trying to apply in his investment decisions. The concept of compounding appears throughout the book, and not just in its financial dimension. Compounding is the mathematical process by which returns build on themselves over time, turning small initial gains into enormous long-term wealth. It is the mechanism that allowed Buffett to build his extraordinary fortune over the course of a lifetime of investing, and it is one of the most powerful forces in the world of finance. But Spear extends the concept of compounding to include the accumulation of knowledge, character, and relationships over time. Just as money compounds when it earns a return that is reinvested, so knowledge compounds when each new insight builds on and deepens the insights that came before. Character compounds when each good decision makes the next good decision slightly easier. Relationships compound when trust and goodwill, built up through years of honest dealing, create networks of support and opportunity that could never have been predicted in advance. This extended concept of compounding provides a framework for understanding why the principles that Guy Spier teaches about how to be a good investor are also principles about how to live a good life. The patience, the honesty, the commitment to continuous learning, the care in choosing who you surround yourself with, all of these things pay dividends, not just in financial terms, but in every dimension of human flourishing. Speer writes, with particular warmth, about the role that reading has played in his education. He is an extraordinarily voracious reader, drawing on books from across many disciplines: history, biography, psychology, philosophy, science. All of these fields have contributed to his understanding of investing and of life. He believes that the best investors are also the most broadly educated people, not in the sense of formal credentials, but in the sense of genuine intellectual curiosity and the habits of mind that come from reading widely and deeply. He speaks of the experience of reading a great book as a kind of time travel, a way of entering into dialogue with the greatest thinkers of the past and of drawing on their wisdom and experience in addressing the challenges of the present. A biography of a great historical leader can teach you something about decision-making under pressure that no business school case study can match. A history of past financial panics can prepare you emotionally for the next one in a way that abstract theory cannot. The recommendation to read broadly is one of the most practically useful pieces of advice in the book. In an age when the pressure to specialize, to be an expert in a single narrow field, is intense, there is something almost countercultural about advocating for the generalist approach. But the evidence of Buffett, Munger, and Speer himself strongly suggests that the best investors are those who bring a wide range of frameworks and perspectives to their analysis, rather than seeing every problem through the single lens of financial analysis. Another key theme in the book is the importance of saying no. For most professionals, and especially for those in the world of finance, the pressure to say yes is enormous. Every new deal, every new investment idea, every new relationship represents an opportunity, and the fear of missing out on that opportunity can be overwhelming. But Speer came to understand, following Buffett's famous advice about the imaginary punch card with only 20 slots for lifetime investment decisions, that discipline and selectivity are among the most powerful tools in an investor's arsenal. Buffett famously said that investing is a no-called strike game. Unlike baseball, where the batter must swing at good pitches or face the consequence of a strikeout, the investor can wait for as long as necessary for exactly the right pitch before committing. There is no penalty for watching pitch after pitch go by. The only penalty is for swinging at the wrong pitch, for committing capital to a poor investment out of impatience or fear of missing out. This principle of patient selectivity is easy to state and extraordinarily difficult to practice. The world is constantly offering new ideas, new opportunities, new pitches. Other investors and analysts are constantly talking about exciting new investments. The market is always moving, always generating new information and new stories. And sitting still, maintaining your discipline, waiting for exactly the right opportunity, goes against every instinct of an active, ambitious professional. But Speer found that the ability to say no, to resist the temptation to act when the right opportunity had not yet presented itself, was one of the most important skills he developed as an investor. And he developed it not through willpower alone, but through the combination of clear thinking about investment criteria, honest self-examination about the biases that drove him toward activity, and the structural safeguards, like the 24-hour rule and the no broker calls policy, that made it easier to pause and reflect before acting. The theme of integrity runs like a golden thread through every chapter of the book. For Spier, integrity is not just a moral virtue to be admired from a distance. It is a practical necessity for long-term success in investing and in life. And its practical importance operates on several levels. At the most basic level, integrity protects you from the legal and reputational risks that destroy so many careers in finance. The history of Wall Street is littered with the wreckage of brilliant careers cut short by ethical lapses, by the decision to cut corners, to shade the truth, to take advantage of information asymmetries in ways that may be technically legal but are fundamentally dishonest. Spier had seen this up close at D.H. Blair, and the experience had inoculated him against the temptation to believe that you could get away with compromising your integrity in the short term without ultimately paying a very high price. But integrity also matters at a deeper and more subtle level. It matters because of its effect on your own thinking and decision-making. When you are operating with full integrity, when there is no gap between what you believe and what you say, between what you say and what you do, your mind is clearer and more focused. You are not spending mental energy on the maintenance of false narratives or the management of conflicting stories. You are not subject to the particular form of cognitive distortion that comes from knowing that you are not being fully honest and that someone might find out. There is a kind of freedom that comes with complete honesty, a lightness of mind that makes it easier to see clearly and think well. And in investing, where clear thinking is the primary tool of the trade, anything that improves the quality of your thinking improves the quality of your performance. Spier also writes about the importance of treating other people, including brokers, analysts, and even competitors, with genuine respect and honesty. He found that his reputation for honesty and straightforwardness opened doors that would have remained closed to someone with a reputation for sharp dealing. People wanted to do business with him because they trusted him. They shared information with him, warned him about problems they saw, and supported him in difficult periods, precisely because they knew that he would deal with them honestly in return. This is the compounding of integrity, the way that a consistent practice of honest dealing builds a network of trust and goodwill that becomes increasingly valuable over time. It is one of the most powerful forms of capital in the world of business and finance, and unlike financial capital, it cannot be counterfeited or stolen. The book also contains a thoughtful discussion of what Spier calls the inner scorecard versus the outer scorecard. This distinction, which Buffett himself has spoken about, refers to the difference between measuring your success by your own internal standards, your values, your principles, your honest assessment of whether you are doing the right thing, versus measuring it by the external standards of others, their approval, their admiration, their willingness to pay you money. Most people, most of the time, are primarily focused on the outer scorecard. They want the approval of their peers, the admiration of their superiors, the respect of the community. And there is nothing inherently wrong with wanting these things. Human beings are social creatures, and the desire for the positive regard of others is deeply built into our nature. But Spier argues that the most successful and fulfilled people are those who have developed a strong inner scorecard, who can maintain their sense of self-worth and their confidence in their decisions even when the external world is giving them negative feedback. This does not mean ignoring the feedback of others, which would be foolish. It means having an honest internal standard against which you measure your actions, and not allowing the short-term fluctuations of external opinion to distort your judgment about what is right. Buffett is the supreme example of someone with a strong inner scorecard. He has held unpopular positions for years, been criticized by experts and pundits, watched the stocks he owns fall dramatically in price, and maintained his conviction because his own analysis told him he was right. And time and again, the passage of time has vindicated him. But even if it had not, he would have had the peace of mind that comes from knowing he acted honestly and thoughtfully, according to his own best judgment. Developing this kind of internal compass, this ability to know what you believe and to act on it despite external pressure, is one of the most important and difficult tasks in both investing and life. It requires a level of self-knowledge that most people never achieve, an honest understanding of your own values, your own strengths and weaknesses, your own biases and blind spots. And it requires the courage to act on that understanding, even when it means going against the crowd. Spier writes about the practices that have helped him develop his own inner compass. Journaling, as mentioned, is one of the most important. The daily practice of writing down his thoughts, his fears, his observations, and his plans has given him a record of his thinking that he can review and learn from over time. It has also helped him to identify the recurring patterns in his psychology, the specific situations in which he is most vulnerable to the biases and pressures that lead to poor decisions. Meditation and physical exercise have also played a role in Spier's practice of mental hygiene. He writes about the importance of maintaining physical and mental health, not as an end in itself, but as a foundation for the kind of clear, focused, disciplined thinking that good investing requires. An investor who is stressed, sleep-deprived, and physically unwell is simply not going to make as good decisions as one who is rested, healthy, and calm. The body and the mind are not separate systems, and neglecting the body inevitably degrades the mind. The book touches on the role of family and personal relationships in the life of an investor. Spier is deeply grateful to his wife, who has been his partner not just in life, but in the long journey of personal and professional transformation that the book describes. He writes about the importance of having a relationship in which honesty and vulnerability are safe, where you can share your doubts and your fears and your mistakes without fear of judgment. This kind of relationship is itself a form of what he calls the right environment, a space in which you can grow and learn and become more fully yourself. He also writes about fatherhood and what it has taught him. Watching his children grow and develop, seeing the world through their eyes, has given him a perspective on what truly matters in life that has deepened and enriched his thinking as an investor. The long time horizons of investing, the decades required for the full power of compounding to reveal itself, become much more concrete and vivid when you are thinking about the world your children will inhabit. And the question of what kind of person you want to be, what kind of example you want to set, becomes much more pressing when you are a parent. One of the more unusual and endearing aspects of the book is Spier's willingness to write about his own deep insecurities and the ways in which they have shaped his behavior. He is honest about his hunger for status and approval during his early career, his tendency to be influenced by the opinions of impressive people, his fear of failure, and the various coping mechanisms, some helpful and some less so, that he developed to manage these fears. This honesty is not just confessional, it serves a teaching purpose. By showing how his own psychology worked against good decision-making, Spier helps readers recognize the same patterns in themselves. And by showing how he has worked to understand and manage those patterns, he provides a practical guide to the kind of self-examination and behavior change that can transform an ordinary investor into an extraordinary one. The concept of learning from failure is particularly important in this context. Spier is emphatic that the most valuable lessons in investing, as in life, come not from the successes, but from the failures. When a trade goes well, it is easy to convince yourself that your analysis was brilliant and your execution perfect, when in reality, you may have simply been lucky. But when a trade goes badly, when you lose real money and have to explain it to your investors, you are forced to examine exactly what went wrong and why. Spier made a practice of conducting what he called post-mortems on his investment failures, honest and thorough analyses of what he had gotten wrong, why he had gotten it wrong, and what he could do differently in the future to avoid the same mistake. These analyses were sometimes painful. They required him to admit that he had been careless or overconfident or subject to a bias he had told himself he had overcome. But they were also enormously valuable, each one adding to the growing body of experiential wisdom that made him a better investor over time. He also encouraged his investors to hold him accountable. By writing openly about his mistakes in his annual letters, he created a kind of public record that made it harder for him to simply forget about his failures or rationalize them away. The act of writing about a mistake, of explaining it clearly and honestly to other people, forces a level of clarity and accountability that private reflection alone cannot achieve. Another fascinating section of the book deals with the art and craft of research, the actual process by which Spier goes about analyzing potential investments. He describes a process that is both systematic and intuitive, combining rigorous financial analysis with a more qualitative assessment of the business and its competitive position. He talks about the importance of reading primary sources, the actual financial filings, the annual reports, the proxy statements, rather than relying on the summaries and analyses produced by Wall Street analysts. The Wall Street analyst community, he notes, is subject to its own powerful incentive biases that can distort their assessments. Analysts who work for investment banks have complicated relationships with the companies they cover, and their research, while sometimes valuable, should always be approached with a degree of healthy skepticism. He also describes the value of what he calls scuttlebutt research, a term borrowed from the legendary investor Philip Fisher, which refers to the practice of talking to the employees, customers, suppliers, and competitors of a business you are considering investing in to get a ground-level view of how the business is actually performing. This kind of primary research, though time-consuming, can reveal information that is not available in any financial filing and can help you develop a much more accurate and nuanced understanding of a business than you could get from reading documents alone. The question of when to sell is one that many investment books address inadequately, focusing almost exclusively on when to buy. Spier gives it the serious treatment it deserves. He notes that the decision to sell is often harder than the decision to buy, for several important reasons. First, you are more emotionally attached to an investment you already own than to one you are merely considering. The endowment effect, the tendency to value things more highly simply because you own them, is a powerful force that can lead you to hold on to poor investments far longer than you should. Second, selling requires you to admit that you were wrong, which is psychologically difficult for most people. And third, there is often no obvious trigger for selling, no clear signal that it is time to exit, in the way that there is a clear signal for buying when the price falls to an attractive level. Spier's approach to selling is guided by the same principles that guide his buying. He sells when the fundamental thesis for owning a business has been invalidated, when the competitive advantage has eroded, when the management has behaved dishonestly, or when the price has risen so far above intrinsic value that the expected return is no longer attractive. He tries not to sell simply because the price has fallen, because a falling price in a fundamentally sound business is usually a buying opportunity rather than a reason to exit. And he tries not to hold simply because he is emotionally attached, because that way lies the sunk cost fallacy and enormous financial loss. Closely connected to the question of when to sell is the broader challenge of maintaining conviction during periods of underperformance. Every investor, no matter how disciplined and principled, will go through periods when their approach seems to be producing inferior results compared to the market or compared to other funds. These periods can last months, sometimes years, and they are among the most psychologically challenging experiences in the investment profession. The pressure during such periods is intense. Investors grow impatient and begin to question whether the approach still works. The press and the financial commentators provide an endless stream of voices explaining why the old methods are obsolete and why a new era requires new thinking. And it is easy to begin doubting yourself, to wonder whether perhaps everyone else is right and you are missing something important. Speer draws on the history of value investing to provide the perspective needed to weather these storms. He points out that even the greatest value investors have gone through extended periods of relative underperformance, during which the strategies they were following seemed completely out of step with the market. And in almost every case, the investors who maintained their discipline through these periods were ultimately vindicated, while those who abandoned their principles at the bottom missed the eventual recovery. This history does not guarantee that any particular strategy will always work. Markets change, and approaches that worked brilliantly in one era may need to be adapted for another. But it does suggest that the decision to abandon a sound, principled approach during a period of underperformance is far more likely to be driven by psychological distress than by genuine analytical insight. And psychological distress, as we have seen throughout the book, is a terrible guide to investment decisions. The role of patience in value investing is so fundamental that it is worth returning to again and again, as Speer does throughout the book. In a world that is increasingly oriented toward the short term, where quarterly earnings reports drive stock prices, where algorithmic traders turn over their portfolios in fractions of a second, and where the financial media creates a constant drumbeat of urgency and action, the patience required by a genuine long-term approach is genuinely radical. Speer has learned to see this long-term orientation not just as an investment strategy, but as a fundamental orientation toward life. The ability to forego immediate gratification in favor of greater long-term reward is one of the most powerful forces in human achievement. It underlies the discipline required to build a skill over many years of practice, to maintain a healthy diet and exercise regime over decades, to build a marriage and a family through the inevitable difficulties of long-term relationship. And it underlies the investment approach that Buffett has practiced for more than 60 years, turning patient, principled, long-term thinking into one of the greatest fortunes in human history. The question of what kinds of businesses offer the best opportunities for long-term value investors is one to which Speer devotes significant thought. He follows Buffett and Munger in looking for businesses with high returns on invested capital, businesses that can reinvest their earnings at attractive rates for long periods of time. The miracle of compounding works best when the underlying business is generating high returns on the capital it deploys, because those returns, reinvested year after year, produce an exponential growth in value that is almost impossible to achieve through any other means. He writes about the importance of distinguishing between businesses that appear to be creating value and those that actually are. Many businesses in capital-intensive industries can generate impressive revenue growth while actually destroying value, because the capital they must invest to generate that growth earns only mediocre returns. The businesses that truly create value for long-term shareholders are those that can grow while generating high returns on the capital they deploy, and that can do so for many years because their competitive advantages are both real and durable. Identifying these businesses requires exactly the combination of analytical rigor and qualitative judgment that Speer describes throughout the book. The financial analysis can tell you what returns on capital a business is generating today. The qualitative assessment is needed to judge whether those returns are likely to persist and grow in the future, or whether competitive forces, technological change, or shifts in consumer behavior are likely to erode them. The concept of the circle of competence, mentioned earlier in this summary, becomes particularly important in this context. The analyst who truly understands a particular industry, who has studied its economics and its competitive dynamics deeply, who knows the players and the trends, will be far better positioned to make this qualitative judgment than the generalist who is looking at the business for the first time. And this is why Speer, despite reading broadly across many fields, focuses his actual investment activity within a relatively narrow circle of industries and business types where he has developed genuine expertise. The book contains some of the most honest and psychologically sophisticated writing about the experience of making large investment decisions that you are likely to find anywhere. Speer writes about the physical experience of committing large amounts of capital to a single investment, the racing heartbeat, the second guessing, the middle-of-the-night anxieties, the tendency to seek reassurance from anyone who will provide it. He normalizes these experiences, making the reader feel less alone with their own investment anxieties, while also providing practical frameworks for managing them. His central message about these experiences is that they are not signs of weakness or of insufficient analytical work. They are simply the normal human response to operating under uncertainty with real money at stake. The investor who claims to feel no anxiety about large investment decisions is either not being honest or not taking the risk seriously enough. The goal is not to eliminate the anxiety, but to manage it, to prevent it from distorting your judgment while using the energy it generates to sharpen your analysis and your preparation. The role of humility in the investment process is a theme that Speer returns to repeatedly. He is profoundly aware of the limits of his own knowledge and analytical ability, and he builds this awareness into every aspect of his investment process. He maintains large margins of safety precisely because he knows that his estimates of intrinsic value will sometimes be wrong. He keeps his portfolio concentrated, but not too concentrated, precisely because he knows that even his best researched ideas will occasionally disappoint. He writes honestly about his mistakes precisely because he knows that pretending to be infallible would corrupt his own thinking. This humility is not self-deprecation or a lack of confidence. It is a mature and accurate understanding of the epistemic situation that every investor faces. The future is genuinely uncertain. Businesses and industries evolve in ways that are impossible to predict with precision. Economic conditions shift in ways that can overturn even the most careful analysis. The only honest response to this uncertainty is to build it into your process from the start, to assume that you will be wrong some of the time, and to position your portfolio so that the inevitable wrong calls do not inflict permanent damage. The question of how much diversification is appropriate is one that Speer addresses thoughtfully. He is not a believer in broad index fund investing, which he sees as giving up the possibility of superior returns in exchange for the guarantee of average ones. But he is also not an advocate for the kind of extreme concentration where a single investment represents such a large portion of the portfolio that a single bad call could be catastrophic. He aims for a middle path, holding enough positions to provide meaningful diversification, while concentrating enough in his best ideas to allow those ideas to genuinely move the needle on his overall performance. This middle path requires difficult judgment calls. How confident are you in this idea? How correlated is it with your other positions? How certain are you that your analysis of the downside risk is accurate? These questions do not have formulaic answers. They require the kind of holistic judgment that only comes from years of experience and honest self-examination. The book also explores the psychological challenge of managing the relationship with your own past calls. Every investor carries a portfolio not just of current positions, but of past decisions, both good and bad. The good past decisions can breed overconfidence, leading you to take excessive risks based on the memory of past success. The bad past decisions can breed excessive caution, leading you to miss good opportunities because you are still haunted by previous losses. Managing this psychological portfolio, maintaining the right balance between confidence and humility, between learning from experience and not being paralyzed by it, is one of the subtler and more important skills in investing. Speer writes about this challenge with unusual insight, drawing on his own experience of the ways in which past decisions, both his triumphs and his disasters, have influenced his subsequent behavior in ways he had to work hard to recognize and manage. One of the passages that struck many readers of the book most deeply is Speer's discussion of what he calls the transformation of his relationship with money. Early in his career, money was a scorecard, a measure of how well he was doing relative to others, a source of status and security and self-worth. This relationship with money, while understandable and common, was ultimately toxic. It made every market fluctuation personal, tied his sense of self-worth to his investment performance in ways that distorted his judgment and drove him toward the kind of short-term, anxiety-ridden decision-making that produced poor results. As he progressed in his education, both as an investor and as a human being, his relationship with money changed. Money became a tool rather than a measure of worth. It was something to be used wisely in pursuit of genuine values, not an end in itself. And as his self-worth became less dependent on his financial performance actually improved. Because the anxiety and the ego that had been distorting his judgment were slowly, gradually replaced by a more settled, more patient, more rational approach to decision-making. This transformation in the relationship with money is something that Spier believes is available to anyone willing to do the inner work it requires. It is not about becoming indifferent to financial success. It is about developing a healthier relationship with success and failure, one in which your fundamental sense of who you are does not rise and fall with every movement of the market. The discussion of giving and philanthropy that appears in several places in the book is connected to this theme. Spier became involved in charitable work, partly through the influence of Mohnish Pabrai, who has a deep commitment to giving and who has written and spoken about the way that generosity transforms the giver as much as the recipient. Spier found that the practice of giving, of using his financial resources to help others in concrete ways, had a humanizing and grounding effect. It kept him connected to the broader world beyond the narrow confines of the investment universe. It reminded him, regularly and concretely, that money is a means to good ends rather than an end in itself. This connection between investing, character, and the broader responsibilities of a person who is fortunate enough to have accumulated significant wealth is one of the themes that elevates the book above the level of ordinary investment advice. Spier is not just trying to help his readers make more money. He is trying to help them build a life in which money serves genuine human values rather than crowding them out. The book's treatment of what it means to be a good employer and a good partner in business is also worth noting. Spier writes about his relationships with the people who work with, and for him, with the same commitment to honesty and integrity that he brings to his investment decisions. He believes that the quality of these relationships, the degree to which they are based on genuine mutual respect and honest dealing, is both an ethical imperative and a practical advantage. People who trust you will work harder for you, share better information with you, and support you more fully in difficult times. This is another expression of the compounding of integrity that runs through the book. The relationships you build over years of honest dealing become an enormously valuable asset, one that cannot be quickly purchased or replicated. And the absence of this asset, the cost of operating in a world where no one fully trusts you because they have learned that you cannot be fully trusted, is one of the heaviest burdens that the ethically compromised professional carries. The final chapters of the book bring together the various threads of investment philosophy, behavioral psychology, and personal development that have been woven throughout the earlier chapters. Spier reflects on the journey that has brought him from the morally compromised young banker at D.H. Blair to the principled, thoughtful, quietly successful investor he has become. And he does so with a combination of genuine gratitude and clear-eyed honesty about how far he still has to go. He is clear that the transformation is not complete, that it never will be complete, and that the belief that one has arrived at some final destination of wisdom and virtue is itself a dangerous form of complacency. The education of a value investor, like the education of a human being, is a lifelong process. The market will always present new challenges, new tests of discipline and conviction, new temptations to cut corners or take the easy path. And the investor who believes they have learned everything they need to know has already begun to fall behind. But Spier is also genuinely optimistic about the possibility of genuine improvement. He has seen it in himself. He has seen it in the people he admires. And he believes, on the evidence of his own experience, that the combination of honest self-examination, principled decision-making, and the cultivation of the right environment can transform not just an investor's portfolio, but their entire way of being in the world. This optimism is grounded in something deeper than financial ambition. It is grounded in the belief that the principles of good investing, patience, honesty, long-term thinking, the willingness to learn from mistakes, the cultivation of character, are also the principles of a good life, and that a life built on these principles will be not just more financially successful, but more meaningful, more fulfilling, and more genuinely connected to the things and the people that matter most. For the global audience reading or listening to this summary, the lessons of Guy Spier's education translate across cultures and contexts. The psychological biases he describes are not uniquely American or Western. They are features of human nature that operate in every culture and every market around the world. The principles of patient, principled, long-term investing that he advocates are not specific to any particular market or asset class. They are universal principles that can be applied by anyone, anywhere, who is willing to do the work. The emphasis on environment is particularly important for investors in any part of the world. Whatever culture you are operating in, there will be pressures pushing you toward short-term thinking, toward following the crowd, toward compromising your integrity for quick gains. And the strategies Spier describes for managing these pressures, the design of a thoughtful investment environment, the cultivation of relationships with like-minded investors, the development of disciplined decision-making processes, are strategies that can be adapted and applied in any context. The emphasis on continuous learning is also universally applicable. The best investors in the world, from Buffett in Omaha to the great investors of Asia, Europe, and elsewhere, are all characterized by an insatiable intellectual curiosity and a genuine commitment to never stopping learning. The specific books and thinkers they draw on may differ, but the underlying orientation toward the world as a place of infinite lessons and possibilities is the same. Perhaps most importantly, the book's central message about the relationship between character and investment success speaks to a deep human truth that resonates across all cultures. The desire to build something of genuine value, to be trusted and respected, to leave the world slightly better than you found it, these are not uniquely American aspirations. They are expressions of the best in human nature. And the argument that investing, practiced with the right principles and the right orientation, can be a vehicle for expressing and developing these aspirations is one that deserves to be heard around the world. As we bring this summary to a close, let us return to the beginning and to the investor who might be reading or listening to this at the start of their own journey. Perhaps you are a young person just entering the world of finance, excited and ambitious, and a little overwhelmed by the complexity and the noise. Perhaps you are a more experienced investor who has been through some painful lessons and is looking for a framework that makes more sense than the one you have been using. Perhaps you are someone who has been investing for years, but has always felt that something important was missing, that the purely financial framework was not capturing what really mattered. Wherever you are in your journey, Guy Spier's book has something important to offer you. It offers a vision of what a great investor looks like, not just in terms of returns, but in terms of character and values and the quality of life that flows from them. It offers practical tools and frameworks for improving your decision-making and managing the psychological forces that work against good judgment. And it offers something rarer and more valuable than either of these things. It offers the honest, detailed, deeply personal story of how one investor made this transformation, with all the wrong turns and painful lessons and moments of genuine progress that such a story inevitably contains. The invitation that the book extends to every reader is not to become a copy of Guy Spier or of Warren Buffett. It is to undertake your own version of the same journey, to find your own way of living and investing in alignment with your own deepest values, and to discover, as so many others have discovered before you, that this journey is not just the path to better investment returns, it is the path to a better life. The education of a value investor, undertaken with honesty and courage, and the willingness to keep learning no matter how many times you fall short, is one of the most rewarding educations a person can pursue. And the classroom, as Guy Spier so vividly demonstrates, is not a school or a university. It is life itself, in all its complexity and difficulty and beauty. The lessons are there, in every market cycle, every business decision, every relationship, every moment of honest self-examination. The only question is whether you are willing to show up, do the work, and remain a student for as long as it takes. And the answer, if this book is any guide, is that the answer is always, always yes.